Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Duggal. Let's get you the headlines. Indian markets snap a 3-day gaining streak as banking stocks head lower.
Vedanta is one of the top nifty losers after the Tamil Nadu government orders permanent shutdown of Sterlite's Tuticorin plant.
Government nominees will propose a new dividend policy to the Reserve Bank of India board. That's word coming in from a government official.
Monsoons have arrived in Kerala, confirms the Met Department. We'll talk about that in a bit, but first the markets and how they're faring today. Neeraj is here as always with a closer look.
Well, a bit of subdued day. Good afternoon, both of you. A bit of a subdued day today, led predominantly by banks and absence of gainers, to be honest. I mean, yesterday we had oil marketing companies and pharma companies doing well. Today we don't have them doing well, and banks are taking a bit of a step back. No apparent reasons. You can argue that rupee, etc., all of that. But yeah, banks have taken a bit of a step back, and that's playing spoil sport for our markets as well. PSUs in particular, it was expected a lot of trading positions were built around the PSU banks moving up today, and sadly for those bulls, the PSU banks have taken a significant step back in the session today. Large, mid, small, almost all of them have pulled back. So that is one aspect. All marketing companies marginally higher. So the rate hikes continue, and the gains for some of these OMCs continue as well after being beaten down out of shape. But I think two pockets have stood out in trade, to be honest, and both of them at the broader end of the spectrum. With the rise continuing in the sugar prices, the sugar stocks are yet again trading at higher levels. So almost all of them, save for one or two, are trading reasonably well. 5, 6, 7%, Sakti Sugars, blah, blah, a bunch of others doing rather well for themselves. So that is one. And 1% beverages, guys, that will feature in the list of almost all market conversations. Second day in a row, down about 20%. Last evening, Bloomberg Quint put out that auditor's note as well, which spoke about how they have signed off because they did not get the requisite information on time, which is in stark contrast to what the management released at about 2:30 p.m. in market hours yesterday. That was purely coincidental. So obviously the market has not liked it. Look at the volumes, very similar to the volumes in trade yesterday, and just shows the absence of buyers and massive amount of sellers out there to sell the stock even after it correcting 40%. Mind you, 21% DI holding, 44% promoter holding. So it's not a stock that is not owned by marquee investors. It is, and yet everybody's been caught on the wrong foot. Been trying to get in touch with the management now for the last 36 hours, I would say. Still no word from them. Hopefully they'll take our call and respond to us at some point of time. But until then, this stock remains the center of market conversations. Just one last point, guys. If you just look at the numbers of the old economy stocks that have come out the last 2 or 3 sessions, L&T above expectations, NTPC above expectations, BHEL, never mind the reported numbers, but if you adjust them for those one-offs that they had to do this time around, the EBITDA margins for BHEL would be northwards of 18%. That's remarkable for a company which is like BHEL and going under a lot of stress. Maybe, just maybe, old economy is showing some signs of uptick, at least in the quarterly numbers reported thus far, if not for all of FY19.
All right, Neeraj, thanks so much. That's a comprehensive check on the markets. But let's focus in on a story which has been developing for days now. India could face a copper supply shock after the Tamil Nadu government ordered the permanent shutdown of Sterlite's copper facility in Tuticorin. The government took action after deadly protests against the alleged environmental damage caused by the plant. While the company maintains that it will try and take appropriate legal action after studying the order, the shutdown could slash the nationwide output of copper and stroke demand for imports. Swansea Alfonso is joining us with the details and the implications. Swansea.
Yeah, Vedanta smelter was one of the biggest smelters. I mean, almost 50% of the production of that India produced last year. So that would mean with this out, India would have to resort to imports at a much higher cost that would affect, the downstream players going forward. And I mean, looking at what consumption is likely to be like, it could triple over the next decade is what analysts estimate. So they had expected India to be a net importer 2 years down the line, but with this latest development, they expect it to be as soon as this year.
Have we spoken to any of the downstream companies to say what their plans are?
So right now, what we have been hearing from the primary producers itself, they say that there has been a kind of shortage that they saw because the plant has been closed since end of March. But and many of them have resorted to imports at a much higher cost. But going forward, this could be a norm for them.
All right, Swasi, thanks so much for that. We will try and get another view on this, an analyst's view. Perhaps a little later on in the show, Rakesh Arora will join us with a sense of what this could mean for the industry and how it could play out for Sterlite Copper as well.
Okay, let's talk about what's going on with Binani. Binani Cement lenders have accepted UltraTech's offer. Sources tell Bloomberg Quint that the committee of creditors have voted in favor of UltraTech's 7,950 crore bid. Vishwanath Nair now joins us with some exclusive details on what's worked in favor of UltraTech this time. Vishwanath.
It's that bid amount actually, Harshna, that 7,950 crore that's working in favor of UltraTech. It's about 1,000 crore higher than what the Dalmia Group bid was, which was closer to 6,900 crore. Dalmia Group, according to some press reports, they've indicated that they don't want to increase the bid. But in all of this, they're still the dark horse because they've already gone to the Supreme Court trying to challenge the whole process. The Supreme Court did not give them any stay, did not stay the proceedings in this insolvency case. But you know, whatever comes out of that hearing will definitely have a bearing on the way this Binani Cement case is resolved. Remember, UltraTech again, it had been through a lot of debate and discussion with the lenders, and then finally now they've gone through this. They've become the highest bidder. They yet to receive a letter from the lenders saying so. But once that happens, they'll go to the NCLT, and the NCLT has to approve the bid. That's the process that's left here.
So it was, for the lenders, it was down to the fact that they were getting far more value than they would have in the other bid.
Originally, they wanted to stick to the process. They wanted to stick to a laid out auction plan. But then the NCLT said that value maximization should be our only concern. After listening to that, they, of course, went back to the table. And then this bid came up as a winning bid.
All right, that is the UltraTech story and the Binani story that has been playing out for some time now. But resolution and liquidation are two sides of this insolvency story that's playing out in India right now. While some accounts are moving towards resolution, there are at least 4 large of the top 12 accounts which are facing the prospect of liquidation. What does that process entail, and what are the costs involved? Vishwanath Nair explains.
Right, Ira. So under liquidation, you know, this process has been IBC's liquidation process has been something that has been going on. If you look at a Credit Suisse report that came out in February early this year, about 38% of the cases till December 2017 have gone into liquidation. Those are the admitted cases. Only 13% actually saw some kind of approval on a resolution plan. The remaining are still under appeal and review. So this is an important chart to note, you know, how exactly liquidation is progressing. The numbers might have changed a little bit, but broadly this is the trend. Let's go on to the next chart to understand, you know, what exactly this liquidation under IBC entails. Primarily, the resolution professional might be appointed as the liquidator for the company by the NCLT. Now, the NCLT is the deciding authority in this matter. The resolution professional has spent 270 days and then therefore is the best person to be put on. But of course, the NCLT has the option of appointing someone else. Once he becomes a liquidator, the liquidator then creates something known as a liquidation estate, which holds all the assets, and then this estate manages all the sales. It also holds all the funds that are collected through these sales, and then those funds are distributed amongst all the stakeholders involved in this case. It could be secured creditors, unsecured creditors, the workmen and employees, etc. Each person is given a ranking under IBC, and therefore that way the funds are disseminated. In the next chart, we'll see some kind of a difference between, you know, how exactly liquidation used to happen in the previous sort of infrastructure and how IBC plans it. In the older format under the Companies Act, the official liquidator was a government appointed person. It was typically a bureaucrat who was appointed as the official liquidator. Under IBC, it's the resolution professional who typically comes from a large consultancy. The difference is, and the expectation is, that because this person is from the private sector and is from a large consultancy, there will be higher efficiency, things will close sooner. But remember that there is actually no time limit for liquidation even under IBC. It was the same under Companies Act. So once it starts, it could go on for a very long time. Under Companies Act especially, things used to go on for decades. Another major difference between the Companies Act and the IBC is the valuation of the assets, and that's the main crux of this issue and why sales don't go through typically under liquidation, because valuation becomes a point of dispute between the buyer and the seller. Under IBC, there is a valuer who's appointed by the resolution professional. This valuer is vetted by the Insolvency and Bankruptcy Board of India, and therefore has some kind of credibility in this whole system. And the value that they assign, it becomes the basis of you know, how things are valued in this process. Under the Companies Act, workmen and employees were given a much lower priority, while under IBC they're given priority even above the secured creditors. So that is a key difference, because typically what happens is when a company is shutting down under liquidation, the employees and the workmen are the most to be hit, because their entire livelihood depends on it. Under IBC, that becomes a major point of difference, and therefore they benefit higher under the IBC process.
All right, some improvements, other cases not so much of an improvement, and the big issue there is the timeline. The former RBI Deputy Governor S.S. Mundra spoke to us about this issue as well, and he said that liquidation should be a last resort. He also, of course, spoke about other things, including the weak public sector banks, and said that some of these banks may not be in a position to maintain an independent identity for long. Listen in.
We have all been talking that the whole resolution process or putting up this framework, always the first priority is resolution and the liquidation should be last priority. So any kind of direction which moves to a mindset that liquidation is the only option, that will be very, very detrimental for the system. That is my clear view. So all attempts, all kind of, even if some flexibility is to be provided, it should first aim at the resolution. That is one thing. Second, as far as I see the framework, once a case is reaching to the last stage, that is of liquidation, and thereafter I think you can't prescribe a time limit for the liquidation. That is quite obvious. What I have seen even in the international area, in the international banking, that if something is put to liquidation, it takes its own time. The realization is poor, that is one thing, but even that poor realization take quite longer to come through. And during this process, the further deterioration also sets in, is whatever is the realizable, assets are available. The running the liquidation process also involves a cost of the people who are running this process, and at times after adjusting this kind of cost and the deterioration, what ultimately comes in hand is really sometimes it becomes quite negligible. So that is the real worry. That is one part of it which is directly affecting the bank's P&L and balance sheet. The other part of this is which is the economic cost to the country, because the company going into the liquidation, there is a question of employment, there is a question of ecosystem, suppliers, ancillary support people who are living around a project. So I think there's a big economic cost to the nation also. So that is how I look at it.
Absolutely, Mr. Mundra. Thanks for giving us that view. Sir, I have one last issue, actually, perhaps the biggest issue that I want to discuss with you. And that is, what do you think is the mindset of the government and the regulator on public sector banks right now? I ask that in the context, sir, that there are 11 public sector banks which have been put under this prompt corrective action. Out of those 11, one has been told to stop lending. The other one has, which is Dena Bank. Allahabad Bank has been told not to increase its risk-weighted assets, which means it can do very, very little incremental lending. What are we trying to do here? Are we trying to shrink the share of public sector banks without actually privatizing them?
See, I won't know that what is the mindset of government or what is the mindset of regulator. I even don't know that there is definitely a mindset which is looking to a long-term game plan, or if there is a strategy. It's quite possible that the things are being dealt with as they come along. So I won't be able to comment on that aspect, because that will be merely doing some kind of wild guesswork. But what I think I can certainly tell, the way I look at it, the number of banks which are under PCA, whether they were under PCA or not, regardless of that, I feel quite a handful of them, at least half of them, even going by the past history and the business progression and the other circumstances which are surrounding them, I clearly don't see a very convincing roadmap for them under which they can justify their existence as the independent entity capable of bouncing back and showing something, a very convincing performance. That being the case, to my mind, at least maybe half a dozen of them, probably the way things look for them, they may stagnate at the level where they are. There is an interesting fact also. Many of these banks are certainly losing their asset franchise, but most of them, sorry, their liability franchise is intact.
Absolutely.
It means with that liability franchise being intact, other things not happening, they can barely manage to at least survive, if not grow. So this survival means only a stagnation. So probably as a gradual, because these things cannot be done overnight, there are other related issues. So they may stagnate for a while and ultimately become a right case to lose their identity with someone else, and then continue to operate as a consolidated entity. That looks like a more likely outcome and probably a course of action which could be adopted.
This is Mundra, former Deputy Governor. The government wants to drop a new detailed policy that will help ensure that the RBI transfers a certain amount of its surplus funds to the centre. This comes after the Finance Ministry had to publicly seek more dividend from the banking regulator last financial year. Nikunj Ori is standing by with some details. So what's the plan here, Nikunj? How does the government want to go about bringing this?
So the government is in favor of having a clear policy that would govern the surplus that the Reserve Bank of India gives to the government every year. Having a clear defined policy for transferring the surplus and calculating the surplus that the RBI gives to the government every year would do away with the need of government having to ask the RBI for a special or an interim dividend. Remember, last year the government had asked the RBI to give a special dividend from the amount that the RBI had transferred to its contingency fund, which totaled to about 140 billion rupees. Now the government, so this policy would do away with this need of having to ask for a special dividend or an interim dividend. Remember, last year the government had asked for a special dividend because the surplus from the RBI had halved because the RBI had to incur additional costs for printing new notes after the government's demonetization drive. Now, government appointees on the RBI Central Board would push for having a new policy which would govern the dividend that the RBI gives to the government every year, and the board would decide whether to externally constitute a committee which would look into this policy, or whether there'll be an internal panel which would decide on the nitty-gritties of this policy. Over to you.
All right, Nikunj, thanks so much for that. Let's get back to our top story, and that's Sterlite shutting down its smelter in Tuticorin. What are the implications of that for Sterlite Copper, also for the copper market here in India? Joining us is Rakesh Arora, Managing Partner at Go India Advisors. Rakesh, good afternoon. Thanks for taking our call. How do you perceive what has played out? Because for all intents and purposes, actually, the plant is shut now.
Yeah, it is unfortunate that something which was operating for 22 years have been shut on account of environmental issues. Per se, the impact on the company is very small. It's like 5-6% of their EBITDA. But, this is a major dent into their already fragile reputation. They have faced issues in past, whether it is Niyamgiri mine or is it the iron ore mines. And with this thing, I think investors will be really wary to invest into Vedanta for some time to come.
What are the implications of this plant closure on the overall copper supply, Rakesh? There are reports to, Bloomberg News has filed a report this morning saying how this would create a crunch of nearly 50%. What's the sense you're getting about supply?
So India has two major, plants. One is operated by Hindalco and other is Vedanta. So half of it, India's supplies are shut now. And India imports copper ore, which is not available in India. And then they smelt it and use the refined copper for domestic consumption. And these companies are also exporting a little bit. So to that extent, India will have to depend on imports for, copper supplies. And, the impact globally, it's a small thing from a global perspective. It's not that big. But still, there would be uptick in TCRC margins, which a smelter gets. And to that extent, I think, copper prices will go up both domestically and probably internationally.
Hindalco probably doesn't have the option to benefit from this, Rakesh, right? I mean, I don't know if they have surplus capacity and if they can sort of ramp up anytime soon.
So both Hindalco and Sterlite were operating at full capacity, but Hindalco might have some benefit because of improving TCRC margins. So they might be able to make more margins out of the same capacity. But I don't think they'll gain too much from volume because they're already operating at full capacity.
Would import and quick turnaround be possible for those downstream companies who require this copper from other countries as well, Rakesh?
So, see, this plant was already shut for last 2.5 months now. And in all probability, people would have made arrangements for imports. So it is possible. It's not a very large sum. It is only 0.4 million ton. So I think imports will be easily possible. Logistics is not a big deal for a high-priced commodity like copper. So it's not a very bulky item.
We'll leave it there, Rakesh. Thank you so much indeed for joining us with your perspective. Rakesh Arora, Managing Partner at Go India Advisors, talking about the impact of the Tuticorin plant shutdown on the overall market. Up next, monsoons have officially arrived in Kerala. We speak to the Met Department to understand if it's across the country.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution hai. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई, हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent. Plain और simple white shirt को बना दे special और fashionable. Fog scent. New fashion wear for men.
You have to chase the value. What market is reflecting is change in the value. It is because of value migration that you keep seeing the new businesses coming up, new companies coming up. It is a wonderful book by a professor from Harvard, a must read.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's an ocean of news out there. Need a navigator? We hear you.
Do you have analysis paralysis? A case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior-most editors. Weekdays at 8 a.m.
Back on lunch, the headlines at this hour. Markets snap a 3-day gaining streak as banking stocks head lower.
BPCL, Coal India, Power Grid and M&M are four big Nifty companies that will report earnings today.
Monsoons have arrived in Kerala, confirms the weatherman.
All right, dip back into the markets, down day, but what's moving on the street? Agam Vakil joins us.
Well, it's been largely flattish, Ira, considering we have seen the Nifty decline by as much as 0.3%. But when it comes to the broader markets, the cuts are not as deep as the kinds we're seeing on the benchmark indices. So when it comes to the mid-cap index, that is largely flattish, and is the same for the small-cap index too. What's really standing out in trade today is, of course, the banking sector. That's where the decline is coming in, and the Nifty Bank down by as much as nearly 1%, and this is largely led by SBI, which is also the top Nifty loser in today's day of trade. That's down by nearly 3% in trade, followed by Yes Bank as well as ICICI Bank. Both these stocks are down by as much as 2.3%. There is some weakness in Asian paints as well, but on the whole, when it comes to the broader markets, again, when coming down to the turnover, that's where we're seeing a sharp surge in the futures and options turnover, considering we are looking at expiry week, and this number of around 6 lakh crores is likely to increase as we move into the next couple of days. So it's been fairly quiet for the benchmark indices, but a lot of weakness on the Nifty Bank Index right now.
Agam, thank you for that. The country's largest capital good maker, L&T, has ended fiscal 18 on an optimistic note. The upcoming elections and therefore thrust on building infrastructure is only expected to aid the company in the current financial year. Darshan is here to take us through the numbers and what the brokerages are making of it. Darshan.
Yeah, so the brokerages are positive. Firstly, let's take a look at the numbers. The numbers were strong. The revenue, in fact, was in line with estimates, but the profits as well as the EBITDA came in much higher than what the street was anticipating. So an 11% top line growth, profit growth of 5%, and EBITDA margins of almost 13.2% is something that came in this time around. Now, basically, if you're looking at the numbers that came in, they did miss the guidance, because firstly, let's talk about the order inflow. Close to 50,000 crores of order inflow in the fourth quarter, much higher than the 40,000 crores that was estimated. Now, for the full year, what is this guidance that they stated for the revenue front, they'd say 12%. They came in at 9.5%. That was a miss. On the order inflow, yes, it was positive. They had said for a flat growth. They've come in at 7%. Now, mainly the infrastructure segment grew 12%. The heavy engineering and hydrocarbon, which are the mainstay for the business, that managed to grow significantly. But that the EBITDA margins also improved there. The other growth came in from the IT and financial services, which are other listed companies of L&T, and they managed to grow significantly in trade. So on the top line growth, yes, there was growth that came in on L&T. Now, in terms of the guidance that they have said for the revenue growth, what they have said is that they are seeing close to a 10 to 15% order inflow or revenue growth guidance this time around. And on the order inflow, the guidance that they've given is 10 to 12%. So this is the guidance that they've given. They've even given a margin guidance, stable margins with a potential upside of 25 basis points. So that's what the guidance that has come in. So that's extremely strong thing that went out. A couple of things that the management did manage to indicate is the fact that the new orders will come in from the governments and PSU companies, because they were slightly cautious on the growth environment. GST, RERA and IBC will drive growth for the company, though they have been dampeners for the company going ahead. Hydrocarbons may pick up significantly over the next few quarters. They are short gestation projects compared to the infrastructure projects. Apart from that, they also said that they may look to exit subscale business, even though they were profitable, given that they will not be able to increase the scale, and EBITDA margins will remain stable with a positive bias. Brokerages are positive. We picked up to CLSA as well as Credit Suisse, which have significantly higher target prices. The common point that they have said is that the numbers were strong. The EBITDA margin is improving. The guidance given is rather strong, and they believe that the working capital stress won't be there. Like CLSA is saying that the hydrocarbon business is growing significantly. There is strategy to improve the growth and ROE, which the management did mention. So CLSA is positive on that. Strong guidance and the margin outlook that they have said, and the margin guidance allays concern on raw material pressure going ahead. Credit Suisse is Credit Suisse, this is the view that's coming in. So overall, brokerages are also positive on L&T.
All right, Darshan, thanks so much for that. The strong automobile demand in India, especially in rural areas, is expected to boost Mahindra and Mahindra's earnings. Yatin Mota is standing by with what analysts are pricing in from the numbers today. Yatin.
Well, if you look at Mahindra and Mahindra, this time we could see a strong 23% kind of a growth on the top line. Of course, this will come on the back of a 25% kind of a volume growth that we saw during the quarter, but probably realizations are expected to dip nearly 1 to 2 percentage points on the fact that we had adverse sales mix, which means that the tractor sales as a percentage of overall sales were quite low, and probably because of which we could see some bit of pressure on the margins on an overall basis, as well as on the realizations. Of course, apart from the strong earning growth that we are looking at for Mahindra and Mahindra, be it the margin picture, the absolute margin picture, or the top line picture, the important factor to watch out for will be the management commentary on the monsoon season and the tractor sales outlook, especially in the rural markets, which have seen some good pickup. Not only that, the management commentary on SsangYong and the commercial vehicle business is something important that we'll be watching out for, apart from the earnings.
Nathan, thank you for that. Let's move on now. Last of the state-owned refiners, Bharat Petroleum will report fourth quarter numbers today. Fall in refining margins is expected to offset the expansion in marketing. Somit Sarkar is standing by with what the street is pricing in.
So BPCL is expected to report a steady quarter on the back of refining margins expected to come in line with the Asian benchmark and on the back of strong gross marketing margins. Now, if you see the headline numbers, the revenues are expected to be higher by around 9% to close to 66,000 crore rupees, while net profit is expected to be flat at close to 2,155 crore rupees. Now, EBITDA is expected to be higher by around 4%, while margins are expected to be stable at close to 5%. Now, gross refining margin, that is a key number for the oil marketing company, is expected to come in at around $7 per barrel versus $7.9 per barrel reported by the company in the last quarter. Now, the gross refining margin is coming off a bit because the Asian benchmark, that is the Singapore gross refining margin, has also come down a bit to around $7 per barrel in the fourth quarter of financial year 2018. Now, the gross marketing margin earned on sale of every liter of petrol and diesel expanded to close to 2.87 rupees and 2.93 rupees per litre in the fourth quarter of financial year 2018. Now, on the positive side, if you see, the refining margins could be better on the back of improvement in the Kochi plant, while on the downside, if you see, the company is expected to report a forex loss as against a forex gain in the last quarter. Along with this, digital discounts and GST is expected to weigh on the company's financial in the fourth quarter. Lastly, on the operation side, if you see, refinery throughput is expected to be higher by around 2%, while the sales are expected to be down by around 8% to close to 9.8 million metric tons. Lastly, key things to watch out for would include inventory and forex change in the fourth quarter, the gross refining margin outlook that the company gives, the Kochi refinery expansion plans of the company, and lastly, update on Mozambique and Brazil exploration blocks that the company has.
All right, thank you for that. Let's move on. Price hikes and higher volumes are expected to aid Coal India's fourth quarter. What are the other factors that are likely to play out in the March quarter earnings? Let's bring in Nikki Mirchandani for the details on that. Nikki.
Thanks, Ira. Well, basic numbers first. We're looking at a 10% uptake on the revenue front to a number of around 24,720 odd crore. In terms of bottom line performance, we're looking at a 91% uptake to a number of around 6,460 odd crore. Margins are expected to expand to 26% as compared to 15%. And also bottom line, we're looking at a 60% growth there year-on-year basis. In terms of other parameters that we like to keep an eye out, especially the raw coal offtake volume, which is seen higher as much as 5% sequentially as well as year-on-year basis. In terms of FSA volume, we're looking at a flattish growth sequentially, but we're looking at a good 4% uptick year-on-year basis. E-auction volumes too are seen higher by as much as 22% sequentially and 9.5% year-on-year basis. EBITDA per ton, which is going to be an important metric that we'll keep an eye out again, is expected to inch higher as much as 33% sequentially to a number of 406. Realization per ton is expected to be in the tune of around 1,500 rupees. Price hike and higher volumes is expected to aid the operational performance of the company, along with the evacuation charge price hike that we've seen for the quarter. This, along with the strong demand which has come through from the power sector, is expected to aid FSA volume growth. The key things or the key other parameters that we'll keep an eye out apart from volumes will be realization and the outlook on the global prices. Back to you.
Nikki, thank you for that. Let's talk about Power Grid now, that also will be reporting March quarter numbers today. Jayesh is standing by to tell us what the street is factoring in. Steady growth, Jayesh?
Harsha, we are expecting to be a steady quarter as far as top line and bottom line is concerned. However, operationally, we could see healthy growth come about. The basic numbers that we are working out with is revenue is expected to grow as much as 15% at 7,725 crores. EBITDA is likely to go up more than 20% at 6,916 crores. Margin expansion is likely to be more than 500 basis points at about 89.5%, and bottom line expected to grow about 18% at more than 2,250 crores as compared to the same quarter last year. In terms of the other factors that we are watching out for Power Grid, it's important to note the capitalization. The normal run rate on a quarterly basis is close to 6,000 crores, but this time around we are expecting more than 9,000 crores. In terms of the segmental expectation, transmission revenue is expected to jump more than 22%. Consultancy, however, is likely to see a drop of about 10%. And lastly, we have telecom revenue, which is expected to grow more than 15%.
All right, thanks so much for that. The stake sale by India's largest registry and transfer agents to private equity firms may have hit a hurdle. Karvy Computershare and Computer Management Services were planning to sell stake to General Atlantic and Warburg Pincus, but a new SEBI panel may stand in the way. Sajid Mangat is here with us to give us the details of that story. Sajid.
Yeah, so in 2017, there were two deals that happened in the RTA space. One was General Atlantic acquiring Karvy Computer shares. It wanted to acquire 83%, and the second one was the Warburg Pincus affiliate wanted to acquire 37.5% stake in the CAMS, or it's called Computer Management Services. The entire stake has been stuck with SEBI for the last 6 to 7 months, and because SEBI wants to take a call on whether control of RTAs should be given to private equity or other entities. And so there was an R. Gandhi committee which was formed. It was looking at market institutional infrastructure, and they were asked to look at RTAs. And what the Gandhi committee has been saying is that they hold a lot of data with respect to securities market in India, and so they should be considered as market institutional infrastructure. And in that sense, the shareholding should be dispersed or held by entities who are under the jurisdiction of a financial sector regulator anywhere in the world. Now, private equities don't come under financial sector regulators, and so this deal is hit a hurdle. Now, SEBI hasn't taken a final call on it. They have sought public comments on it, but R. Gandhi committee is very clear on that shareholding should be dispersed, that the regulated entities should have control. If they are not, then non-regulated entities together should hold as a whole not more than 49%, with individual entities holding not more than 15%. It also talks about how ownership requirement may be required to put in especially in qualified agents. Now, qualified agents are those who are holding more than 2 crore portfolios, and both Karvy and CAMS have nearly 90% of the Indian market, and so they are big in that sense. The committee also went ahead and said that these entities should have public interest directors. Now, something similar to what stock exchanges have, where SEBI puts in their directors as independent directors on the board. In case if the chairman is non-executive, then 1/3 of the board should have PIDs. If the chairman is not a regular non-executive, then half the board should be PIDs. So these are some of the committee recommendations which the board of SEBI would be looking at, and as and when the board takes a final call, this private sector equity deal will be taken. But as of now, if SEBI goes by what R. Gandhi committee is saying, private equity may not be getting control of these two companies.
And both these deals may be stuck for now, at least.
Yes.
Sajid, thank you so much for joining us with those details. Let's move on. Monsoon has finally arrived, officially arrived, that is. The weatherman has confirmed that the rain clouds have hit Kerala 3 days ahead of schedule, just as it had predicted. In a statement issued earlier today, the Met Department added that conditions are favorable for it to further advance into remaining parts of Kerala, Karnataka and the northeastern states during the next 48 hours. KJ Ramesh, DGM at the IMD, now joins us on the show. Mr. Ramesh, thank you so much for joining us. Can you give us a sense of the progress of the monsoon here on? Are you sticking by your earlier forecast? What have you made of what's happened today?
Yeah, monsoon has advanced over the South Kerala, and it is now the current monsoon line is up to Kannur on the west coast, interior Coimbatore, and then Tuticorin, and then most of the Andaman Nicobar Islands are covered today.
Sir, the fact that this has come in much earlier than anticipated, are you expecting the progress of the monsoon to be as per schedule as it was last year?
No, that way, see, climatological date is 31st May. It is only few days before that. We have a forecast error about plus minus 4 days always happens. Anything between onset taking place between 27th May to 4th January is to be considered as a normal date of arrival of monsoon for South Kerala.
So from all your forecasts so far, Mr. Ramesh, it looks like we're headed for a normal monsoon. What would be the data points that you look from here on?
No, monsoon onset is not linked to the overall seasonal rainfall scenario of the country. That remains almost the same at the same level. We stand so far. We have not updated our second stage forecast. So that will come in a couple of days. We are working on it. And then as far as the seasonal scenario is concerned, it is 97% with a good distribution of rainfall, we said. That means it will be a third successive year for Indian agriculture and the food production associated with it.
All right, sir. Thank you so much for joining us. Appreciate you taking the time to speak to us. We've got some earnings coming in. Can we throw those up on the screen? All right, we will try and get you those before we close off. A couple of the important earnings that we'd flagged off that were likely to come in included M&M, and perhaps that should be hitting your screens fairly shortly. Not sure we have the numbers on our screen right now yet, though.
It's the age of disruptors, says Shiv Puri of TVF Capital Advisors. He expects renewables in the power sector and fintech among financials to change the course of the industry, and that's where he's placing his bets. Listen to the conversation we had with him earlier today.
It's very difficult to pinpoint valuations of companies whose future is highly uncertain. There's almost no price that gives you that level of comfort because you don't know how steep the cliff can be. So, while this could be something in India that plays out over a longer period of time, and therefore if the valuations are cheap, they might look sensible, but it's a very difficult game to get right.
Yeah, I guess so. Interlinked to this pocket or these pockets, Shiv, because these are capital intensive projects, are the financiers of these projects. Now there is hope that at some point of time some of the monies that have been invested into these projects might see some returns. What happens there? Do you believe that those are lost causes as well?
Well, it depends on which specific project, whether it's operational, what sort of PLF it's operating at. But if you look at the state-run banks, the biggest source of problems that are emerging now is the power sector. They've taken down all the recognition on infrastructure and the other areas, but power is where the pain is still ongoing.
That's true. Okay, let's dwell a bit on the financial space there. I mean, if I look at your holdings as well, at least the ones that are available on a terminal, you are betting in a reasonable way on some of the financiers. So many people tell me about the lending super cycle that we are already in, or maybe amidst, at the household debt to GDP ratio for India compared to the EM market, Korea, or any of the others so low that people will borrow more, and therefore all financiers which manage their books well will do well. Do you subscribe to this thought? And if so, it's such a big bucket, where is it that you think the winners will emerge from?
Yeah, so financial services in India have got two components. One is the underpenetration, what you're talking about, which has a ways to go. But the second is also the market share shift, which still has also a long way to go. So it's a combination of those two things that will play out. The important thing, I think, in India is to realize that the private sector banks and some of the financial services companies, the well-run ones, are in a wonderful position structurally. And it's not because their balance sheets are good and they're taking share from the state-run banks who have NPA issues. That's, we all know. But also because in a world where technology is going to get more and more valuable, I've been saying this for a while, the delta between them and the state-run banks is only going to widen. And it's very interesting. In India, one of the, I think, very sensible things that have happened is that the government has opened the digital platform, right, with the UPI and they've developed apps on that like Beam. We obviously have the mobility penetration rate that's already there. And private sector banks are the ones that are sitting on the data of consumers. This is very different than the China model, which I've seen at very close quarters, where you have two payment companies that control the data, that control the transactions, and have all the history. So in the context of India, I think these are the companies in the private sector space that have the huge advantage. Now they have to leverage it, and they have to be doing things, and I think some of them are doing that very well.
Interesting. You may not be at the liberty to name stocks, so please feel free to not do that. But and please correct me if I'm wrong, but if I look at your holdings, Shiv, you don't have too many large private sector banks, right? I mean, you have holdings in City Union, Repco, Bharat Financial, which are not necessarily the A-list, so to say. How is it that then you've chosen the kind of bets that you've chosen? When you're talking about how it's the private sector banks, etc., which seem to be at the forefront of this revolution, if I can use that term.
Well, like I said, yeah, you're right. I can't name any names, but I'll say that the list is very dated. And if I look at some of the larger private sector banks today, they are in an unusually good position. Because they have, first of all, world-class management teams. If you look at some of the statements that are coming out of some of the well-run companies, and you see their behavior, you have CEOs spending time, weeks in a year in Silicon Valley, and they are attracting some of the talent from there. There's a big private sector bank that has a large incubation set up in Bangalore, where they're incubating 30 or 40 companies. They're really thinking of how to partner with these companies in the fintech space. And these companies in the fintech space also realize they need the customers of the banks. They're not going to be able to get them like they did in China. So these guys are unusually well positioned. And some of the results are already starting to show. I mean, if you look at the cost to income ratio of these banks over the last 4 years, they've gone down quite dramatically. And I think there's a lot more that's going to come on that front.
Interesting. My final question, Shiv, you spoke about how a couple of large companies in China dominate one aspect of the financial services space, if I understood you correctly. That seems to be the case that could happen in India in the retail space, right? With the latest move that's happened and the large deal, Indian online retail at least will be dominated by two major players. At least seems to be the case. Have you looked at the Indian retail space, both offline and online, and who do you think will emerge triumphant over the next 4 or 5 years? Are you betting on this space at all?
It's interesting. I mean, India is one of the unique markets where you've got the equivalent of a Walmart and an Amazon coming up at the same time. In the US, what happened, you had, mom and pop retail move to organized big house retail, discount retail like Walmart did. And then, after a number of years, Amazon came. Whereas in India, the organized retailing industry, the brick and mortar industry itself is very young. So you've got both these models that are coming up simultaneously. And in the context of India, I think both have their place, and they both have some advantages. So I'm not so sure it'll play out like the US, where the entire market, like you said, has moved online. I think there's an opportunity here for both sides.
Okay, that's a view from Shiv Puri of TVF Capital Advisors. Meanwhile, Mahindra & Mahindra has reported fourth quarter numbers. Other income has boosted the automaker's bottom line, although the top line disappoints. That stock is, spiked up in the last couple of minutes. Yatin is here with the fine print.
Well, Harsha, if you look at Mahindra & Mahindra, the Mahindra & Mahindra plus MVML entity, they have posted a healthy set of numbers. In fact, if you look at the operational performance and the normalized earnings, we have the EBITDA, which has come in at almost 1,995 crores versus the Bloomberg poll of 1,880 crores. So almost round about 110 crore beat coming in on the operating front. And if you look at the operating margins, they have come in at a level of 15.1% versus our pool of close to 14.4%. So on the operating front, it's a clear beat as far as Mahindra & Mahindra is concerned. Of course, there has been a small miss on the top line front. Revenues for the Mahindra & Mahindra plus MVML entity stood at 13,189 crores. That is a growth of nearly 26%. We were working with a growth of close to 23%. So good realization growth is what we have seen for the quarter gone by. And if you look at the profits after tax and after extraordinary income, that is close to 1155 crores again. Almost 100 crore beat coming in there. So if you look at the entire results for Mahindra and Mahindra plus MVML entity, and that is the number which matters, the numbers have been slightly better than the street expectation, at least on the operating front.
I think we're getting an analyst view. Bharat Gyani of Sharekhan is joining us. Bharat, good afternoon. What did you make of the first cut on the M&M numbers?
Yeah, definitely. Good afternoon. The numbers definitely are a beat as far as the operating performance is concerned. So clearly the operating margins at 15.1% is better than what ourselves and the consensus was expecting. So we are expecting about 14% and the operating margin has come in about 15.1%. I would like to highlight is while the tractor margins have been broadly, EBIT margins have been broadly in line at about 19.5% for the quarter, but the clear outperformer here is the auto sector. So the auto sector has reported a margin of about 11%, close to 11% EBIT margin. This is after this is clearly what above the what street was expecting at. So EBIT margins of auto sector, the street was expecting about 8.5%, and they have delivered close to in excess of 10%. So clearly, while the tractor is broadly in line, auto has outperformed for M&M this time around.
Bharat, this is Yatin joining in from the research team. If you could also give us an idea as to almost a 250 basis points beat on auto segment EBIT margins. Is the trend sustainable given the fact that we have higher commodity cost and in general the discounting is higher on Mahindra and Mahindra vehicles in the marketplace according to dealer checks? So do you think all of those odds and despite all of those challenges, we had a good EBIT performance and this probably would continue?
I think this time around the auto volumes on a YOY basis there was a 20% increase for M&M. Obviously the base effect also had some impact on this. So I think this kind of growth, so in this quarter 20% there was a fair bit of operating leverage as well which was available for the automotive segment. The growths may taper off because the base effect the benefit of low base will no longer be available as we move ahead. So I think and given the commodity prices which are on the higher side, this kind of margin may not be sustainable.
Okay, and given the fact that we have a 15.1% EBITDA margin for the Mahindra and Mahindra MVML entity, would you be raising your earnings estimate for FY19?
We need to watch the management commentary for the same, but I guess the results, as far as if we see only the results, then we may have to probably take our estimates a bit on the higher side.
Okay, Bharat, we'll leave it at that. Thank you so much for speaking to Bloomberg Quint. Harsha, it's over to you.
All right, Yatin, thank you so much indeed. Out of time on the show. Thank you so much for joining us on lunch today.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार,